Friday, April 7th. There's a link next to this photo with a longer version of this copy for those who would like the details. At the end of today, the all-definitive United States 10-year Treasury note yield is the same as it was last Friday, which means nothing happened. The reality is that so much happened, so much is happening, that it's hard to figure out. You can't touch on all of it. You can't even describe all of it, and you can't link it all to markets. So get to the bottom line. But through, let's see, we went through a nerve gas attack by Syria, a missile launch by North Korea, just as Xi Jinping got off an airplane in the United States. Mr. Trump, no matter how you feel about him, a lot of things happen near him. Whether it's what he's saying or tweeting or doing, it's busy out there. Through all of that, on Wednesday afternoon, the Fed released its minutes of its March 15th meeting. The Fed has made it very plain, painfully plain, that the bonds and mortgages which it bought during the period of quantitative easing, meaning 2008 to 2014, it bought those bonds and mortgages to try to keep markets liquid, to push down on long-term interest rates and give markets a chance to heal. The Fed bought a little more than $3 trillion worth of United States Treasuries and mortgages. It is now intent on unwinding those holdings, and will begin to do so around the first of the year, not very many months away. And the Fed is already very firm that it intends to normalize the overnight cost of money. The Fed said on Wednesday that it might hold off raising the overnight cost of money while it unloads $3 trillion worth of treasuries and mortgages. That would be nice. Or it may not. And meanwhile, backdrop, the U.S. 10-year Treasury note has been between 2.3 and 2.6 since the end of November. No higher, no lower, which has kept mortgages between 4.375 and 4.125, 4 1/8, 4 3/8, low fours, all the way through this period in which the Fed says, we're coming. We are on the march. We are coming. Nothing has happened to mortgage rates. Nothing at all. It got, the whole thing reached the outer limits of nuts by yesterday, when we were all sitting around waiting for new employment data, which would be released at sunrise this morning. We're always worried about it. It's a funny number that isn't as precise as it should be for the most important single piece of information. And last night at 9 o'clock, across TV screens everywhere, breaking news, United States missile attack on Syria. And you could watch the 10-year last night. I mean, there's trading during the night go down. And first thing this morning, we got a relatively weak employment report, distorted by bad weather during the week that the Department of Labor surveyed businesses looking for the level of employment. And those two things combined, you know, we've been sitting in the same place for months and months and months, and we should have gone lower, and we did not. We went lower very briefly earlier this morning, and rates rose the rest of the day. We are still in that range of 2.3 to 2.6. Optimists think that we're going to stay in it, and I don't want to be grumpy on a beautiful spring Friday afternoon, but if the Fed's going to continue to hike, going to continue to raise the overnight cost of money, and unload the better part of $3 trillion worth of treasuries and mortgages, it's inconceivable that long-term rates stay where they are. The clock is ticking. And there's a clock joke in the copy next to this video, and a market clock joke. But I think we're on notice that what we have seen in this period are the lows that we're going to see unless something happens to the economy and it slows down. And just be prepared for some moment without any particular warning when all of a sudden we take the next step up. On that cheerful news, the economy is doing better. Some of the numbers are peculiar and make it look as though it's not, but it is doing better, and that's the other reason behind all of the upward pressure on interest rates. Good weekend.